activar la grabación. A saludar a nuestro facilitador. Bueno, ya voy a apagar mi video porque normalmente la conexión interrumpe. ¿Me escuchan bien? ¿Sí? ¿El sonido está bien? Anoche me terminé la investigación económica o el curso de investigación económica. Me dijeron que no se oía muy bien.
Sí, se escucha bien, Víctor.
Muchas gracias. Listo. Okay, mientras se van sumando los compañeros, déjenme comentarles, a ver, primero que nada, asumo que todos están pendientes a las noticias de Estados Unidos. Yo tengo en el televisor de adentro la CNN prendida, atento a lo que va a pasar, porque evidentemente la elección de Estados Unidos tiene un impacto en nuestra economía. Para empezar, se espera una reducción del dólar, si es que gana Biden, se espera un cambio en las tasas de interés en el mediano plazo, y esos son temas que evidentemente nos van a impactar directamente acá. En segundo lugar, tratando de compartir la pantalla y se está haciendo un enredo. Aquí está la pantalla 2. Quería mencionarle de esta conferencia o charla que va a haber, que se ha diseñado conjuntamente entre las facultades de Economía y Finanzas y la Facultad de Derecho. Esta charla va a ser el día viernes 13 de noviembre, a las 12 p.m. Esto estoy cogiendo el Facebook de la universidad, nos ha llegado un correo, deben haber recibido también un correo de parte de la Facultad de Finanzas, o mejor dicho, el Departamento de Finanzas. Y lo bueno, interesante de esta charla es que va a tener la oportunidad de escuchar directamente de exalumnos cómo es el trabajo en M&A en estos momentos, ¿no? En sus distintos ámbitos y en sus distintas empresas, ¿no? José Gabel lleva varios años en JP Morgan, Ricardo Anaya, que es de la Facultad de Derecho, lleva buen tiempo también en Nexus Group, tienes a Daniela Delgado en Goldman Sachs, y el estudio Rodrigo Elías, María Angélica Meneses. Uno de los temas que van a identificar en general, los procesos de M&A son liderados muchas veces por no bancos de inversión, no boutiques de bancos de inversión, pero también por estudios de abogados, ¿no? O sea, si bien los asesores financieros, los banqueros de inversión, vamos llevando el proceso, vamos de la mano con los abogados para poder llevar a buen término la ejecución. Y los estudios tienen unos departamentos de M&A bastante fuertes, y en muchos casos ellos por sí mismos han liderado procesos de M&A sin necesidad de recurrir al típico banquero, ¿no? En un esfuerzo de tratar de hacer una valorización sencilla o un precio ya medio acordado entre las partes, y entra simplemente el abogado a solucionar los problemas tributarios, contingencias y demás que normalmente se observan en un proceso de M&A que vamos teniendo. Sorry. Okay, I'm fine. So, coming back here, the second thing I wanted to show you is here. So I have uploaded some information. I have uploaded a presentation that we're going to review today regarding cash flows, right? And we're going to continue developing our exercise on cash flow that we started last week regarding that's the 10K for Ferricorp, right? That we were analyzing the audited financial statements for Ferricorp that I have right around here, right? That we were reviewing last time. But more than that, I have uploaded some readings that you may find them useful, right? It's not that they are necessary readings for anything that we're going to develop on the seminar, but they are actually helpful technical documents that explain how you should be calculating free cash flow, capital cash flow, right? And equity cash flow. And it goes even further because it actually explains you what are the key differences with the valuation methodologies that we're going to barely touch in this seminar, which are weighted average cost of capital or discounting cash flows, and coming up with the enterprise value, right? And the other alternative to do that, right, is the adjusted present value methodology. That for those of you who have taken my corporate finance 2 course know that I do promote that as being a more sensible approach to calculate the enterprise value of companies. But truth to be told, and we are going to be reviewing that in the following sessions, right? Most practitioners stick with weighted average, right? Although we are going to promote adjusted present value, and I'm going to discuss that in a bit. Most people that you're going to see in the investment banking world, in valuing companies, analyzing, just focusing on WACC, right? That's the way it's right now. Eventually, there's going to be some movement towards adjusted present value. And I do suggest that you do try to calculate using adjusted present value. And as I explained in my other class, the good thing is that if you perform adjusted present value evaluation, you may arrive to a more accurate number. And if that is the case, you may end up having a better hand in the negotiation table with your counterpart, right? If you are capable of coming out with a better understanding of the value that you have in the company that you are analyzing, you are better off negotiating that. Okay, without further ado, let me jump into the presentation that I have already uploaded over there. Let me check it out. This is this one that I have it over there. Let me move to the side. Or what happens if I do this? Sorry, 1 minute. Okay, I think that works for everybody. Okay, so in order to talk about discounted cash flow that we started discussing last time, right? I focused on free cash flow at the beginning, but there are actually 3 different ways to come up with the value of a company, right? Remember, today we want to arrive to the equity value. We want to calculate the equity value, but it is sometimes very difficult to figure out what are the free cash flows, or better said, what are the cash flows that are related to the shareholders that I should consider to come up with the equity value, right? So in order to do that calculation of the equity value, we opt to an alternative. We are going to come up with the enterprise value, which is the value for the whole company, right? That considers what can be claimed by debt holders and by shareholders, right? You are calculating the value of the whole assets, right? The market value of the whole assets. So we're going to consider 3 different approaches, and we're going to touch base when to use each one of them. So the first one, is the free cash flow methodology, right? And it's going to provide you with the enterprise value. The second one is called the capital cash flows, and we're going to review each one of them in the following slide. It's also going to give you the enterprise value. And the third approach is the equity cash flow that provides you with the equity value, right? In general.
Víctor, creo que tienes el micrófono apagado.
Sorry about that. That's silly me. So let me recap what I was saying. So what I was mentioning is, okay, we're going to come up with the enterprise value and the equity value, right? And the main objective arriving to the equity value, as I said, But since it's very difficult to arrive to that number directly, we're going to opt to the alternative route to calculate the enterprise value, and then we subtract the debt value to arrive to the equity value, right? So just to be sure that everybody's following me on here, where's my template here? So we do know that here we're going to be talking about that the enterprise value is equal to the equity value, right? Plus the debt value, right? And I'm going to put here a word that is called net that we may talk in a little bit. Is this font a little hard? It's not letting me change that. Well, let's So we're talking about the typical equation that you see in accounting, right? Assets equal liabilities plus equity. But instead of talking about the liabilities as a whole, right? We focus on, okay, all those accounts payable, all those other accounts payable and non-debt items that are on the liability sides, we can move them to the asset side as negative, right? So you have an asset net. Let me quickly go over that to make it more clear and explain it better. Where is my screen sharing? Oops. Okay. So what I'm saying is this, right, guys? You do know that our typical element is assets equal liabilities. That's the typical accounting equation that you're going to see, right? So you have this, you have liabilities here, right? And you have equity out here. For a total typical balance sheet approach that you're going to see along the way along. Right? What we're saying is from a finance perspective, right? From a valuation perspective, let me put it that way better, right? The way we want to highlight this is, okay, there's going to be here in the liability side, right? There's going to be some elements that we will consider as debt, right? There's going to be some debt here, and there's going to be some elements that are non-debt related, right? The typical, your accounts payable. What we are saying here when we are calculating the valuation of a company, right? When we are going to be discussing this analysis is, okay, let's do something similar to this, right? But we are going to be moving these non-debt relating items, right? We are going to move them from this side. Let's have a over here, should be this one. Here, we're going to move it from the liability side to the asset side, right? So we're going to have here assets, what do we call it, net, right? And we're going to have here debt. And the way we're going to try to do this, obviously, is that the enterprise value, right, is going to be the debt value plus the equity value. That's our main objective, right? And all I'm saying is, in all this analysis and modeling we're trying to do, right, the main idea to perform this are two main objectives, right? At the end of the day, when you are doing this modeling. The first objective usually is valuing the company, right? You're trying to figure out what is the value of the equity of the company, and you're trying to come a number in order to sell the company, right, to some other party, right? As either a minority shareholder or another party that takes control, right? The other objective normally to perform this modeling that we are talking about, it's coming up with how much debt the company can take, right, in order to survive a situation of a shortage of liquidity, right? We want to put more debt into the company. What's going to be needed, right? And that's why we're modeling. But most of the time, it's going to be this M&A calculation that I'm preparing over here, right? And the way I'm saying is we're going to be having this debt, and this equity. And I'm going to put here debt net, right? Let me put it more clear over here, because what we are going to observe is that you should subtract from your financial obligations, from your debt, all the excess cash, right, that you have typically here on your balance sheet, right? If you have some excess cash, we're going to come up with this. Guys, what is happening, right, when we are calculating the free cash flows and discounting them, weighted average cost of capital, let's talk about weighted average cost of capital for a minute, right? What we are basically saying is that the market value of my assets, right, is equal to the present value of all future cash flows I'm going to be capable of generating out of them, right? That's what we're saying when we're calculating this as the enterprise value, right? Enterprise value is equal to the sum of free cash flow discounted at WACC, right? So basically, we are focusing on how much free cash flows these assets are going to be capable of generating in the coming years, right? In perpetuity, when we come up with this valuation. And that's the key element I wanted to highlight when we are analyzing. Any question what I'm just showing you? Okay, realize that, by the way, when we talk about last class about NIF 16, right, and the fact that these operating leases are being capitalized, right, these rent agreements, long-term rent agreements, are being put in the asset sides, right, on PP&E, and also on the liability sides as debt, right? Because it recognizes that there's an obligation with you, a financial obligation to pay those, right? They're not affecting the equity, right? If you are correcting value on the asset sides and on the debt side, right, you should be arriving to the correct valuation of the equity. There's no effect on that, on the equity value we have. Okay. Let me come back here. Right. So as I was saying, we are going to go with these three typical cash flows, right? And as I was mentioning, there's going to be an enterprise value, right, that we can calculate. We can use the free cash flow and discount it as the weighted average cost of capital, which is the most popular one. We can opt to an alternative way. This is called the adjusted present value methodology, right? And I'm going to touch base on that later on. But as you can realize, you also use the free cash flow here. So your numerator in the summation of different fractions in the future, right, is the same. But the discount rate is different. The denominator is different. You're going to be using the required return on assets, right? And for those of you who are familiar with, you should know that this free cash flow discounted the required return on assets is going to give you the value of the unlevered company. The value of the company if it didn't have any debt. And what are we adding to that? We're adding the value that we obtain from. So remember for a minute Modigliani and Miller, right? Modigliani and Miller 1 said that it doesn't matter how you finance the company, right? It says that the value of the company is going to be the same. That was Modigliani and Miller 1 saying there's no taxes, there's no element that affects my calculation, right? So it doesn't matter if I finance with debt and equity, value of the company is going to be the same. Then comes Modigliani and Miller 2, right? When they incorporate taxes, right? And they realize there's some value in the debt. And the value that is coming from the debt is coming from the income, right? The possibility that you do not pay taxes based on the interest expenses that the debt generates. Okay, that is fine, right? And remember, when you are working out, here, right, when you are using the weighted average cost of capital, that interest taxable benefit is embedded in the formula for the weighted average cost of capital. Weighted average cost of capital, for those of you who do not recall that, right, let me jump it over here, it's right here in one of my slides, is the cost of equity, right, required on equity, multiplied by the proportion of equity over a total value, right? Let me increase this a little bit. right, over the total value of the company, right, equity over debt plus equity, plus required return on debt. And this is where you incorporate the interest taxable effect, right? 1 minus T, right, that to consider the after-tax cost of debt, recognizing that the interest expense generated by the cost of debt create a benefit to the company, and then multiply that times the proportion of debt over total value. Realize that obviously as this number, as the multiply times 1 minus t, being t a number between 0 and 1, right, decreases this value, the weighted average cost of capital increases, the total value of the company, right, rises. It goes up, right? The higher the lower the WACC, the higher the enterprise value. That's a typical thing you have seen. So all I'm saying here, for those of you who are not familiar with APV, and we're going to touch base on that later, is that there's an alternative approach, right? This is becoming more and more popular. Right? I'm crossing my fingers over there. And we are going to be calculating the first of the unlevered value of the company without any debt, and then treating the interest tax shield separately. What is the benefit of that? You can model the interest tax shields better if there are changes in debt over time, right? I have used here to discount those interest tax shields, the required return on interest tax shield. More on that later, right? I don't want to confuse you anymore. If you are not familiar with APV, for those of you familiar with APV, this is simple and refresh. Okay, and then there's another alternative that I just mentioned for cash flows, right? One of them is called capital cash flows. And capital cash flows should be applied, right, in those scenarios where the company has a significant amount of leverage, such as in an M&A transaction called leverage buyout, right? In these situations, when you have a high amount of leverage or a high percentage of leverage over the total company, what it normally occurs, right, is that the risk of these interest tax shields is very similar to the risk of the whole company. And using weighted average cost of capital do undermine, right, do reduce the consideration for risk that the company is taking. Because remember, the higher the leverage the company, the higher the possibility that the company can, right? The more difficult it is for the company to generate enough cash flows to repay the interest, or pay the interest expense, right? And repay the debt consideration, the principal of the debt, according to the debt scale, right? That's the difficulty that we have, right? Capital cash flow obviously is also an alternative approach that should be used, and we're going to touch base later on that when you are in a financial distress situation, by the way, does not mean that you are bankrupt. It means that there's a shortage of liquidity, right? Most companies do not go bankrupt by themselves. They go bankrupt because they are not capable of repaying the short-term liability. They are not capable of paying them up because they do not have enough liquidity. It's not that their net worth is negative, right? It's not that the equity value is completely negative. It comes to the point where I'm not capable of generating enough cash to repay the debt, right? And that actually becomes a problem with the bank. But more than that, it can also be a problem that you cannot be capable of paying your suppliers, your employees, right? And that goes along the way of that shortage of liquidity. Okay. These three alternatives that I just touched base on are going to help us calculate the enterprise value of the company. Right? And as I said, we are going to be calculating the enterprise value. Right? And if we deduct from that the debt value, as of today, as of the time that we calculate the value, obviously we're going to arrive to the equity value. An alternative approach to that obviously will be to consider the equity value, right, and come up with to try to calculate the equity value better said. In order to do that, right, we're going to need the equity cash flow, right? So logically, we're not going to discount them as WACC, right? If these are the cash flow to the equity holders, they should be discounted at the appropriate discount rate, reflecting the risk of those cash flows. Logically, to reflect the risk of those cash flows, we should discount that at the required return on equity, at the cost of equity, the cost demanded by the shareholder. So there are, as you have already know from other classes, and calculating WACC, required return on equity is not difficult to come up with, right? There are several models there for capital asset pricing models, right? APT to come up with that, or multi-factor models, right? And we're going to focus on CAPM, which is the most common one. But that's not the difficult part, right? And we're going to drill into that in later sessions. The difficult part is the equity cash flow, right? That's the complication one. And you probably have seen in Corporate Finance 1 or the classes, right, that you try to estimate the equity cash flows based on the dividend Gordon model, right? You imagine that there are going to be some dividends into the future, right, that you are going to be repaying your shareholders, and eventually you arrive to either a percentage of net income, right, or fixed dividend number, right? The problem logically with that is that there are certain circumstances where you do not want to give dividends necessary to the shareholders, right? If you are deciding to reinvest everything into the company, and if there are some situations like financial distress, as I was mentioning, or a situation where you are going to increase significantly leverage, and you decide, or the banks force you not to give dividends, right? That this calculation is going to be correct, right? That equity cash flow valuation that we are talking about is not going to provide you with the correct estimation, right, of those cash flows into the future. That's the difficulty that we're going to be having. Right. By the way, yeah, it is very typical if you are getting into more debt, right, than normally in a company, that the financial institutions do demand that you're not going to be paying you dividends, right, for a certain period of time, unless you decrease the amount of leverage to a certain point. Remember the typical ratios, debt over EBITDA, right, to come up with if that makes sense or not to have that level of into the company, or debt over free cash flow at all, or interest plus a principal payment divided by EBITDA, right? That's gonna be debt service level, right? That we have been talking about. So jumping into that, right? As we have been saying, and I already mentioned this, I believe, in a bit, right? Free cash flow methods usually it's applied with the weighted average cost of capital discount rate, right? And we are going to come up with the enterprise value, right? And as I mentioned, you should remember that the, so it's not letting me, there we go. The tax advantages that we are having, right, are implicit into the discount rate, right? And the lower the discount rate that we are going to be having, the higher the enterprise value, right? So the cash flows are not including those tax benefits, right? And I'm putting here a free cash flow formula we discussed last class briefly, more. And you don't know, we talk about this, that it's going to be the EBIT, which is the operating income, right? It's actually better to highlight it this way. The operating income line that we have, right? Let me jump this for a minute. We're going to have to add back the depreciation, because depreciation is not a cash expense, right? It's a non-cash expense, and you are adding it back, right? We are subtracting the increase in net working capital, recognizing that there are some sales, some revenues that are considered in EBIT, and some expense considered in EBIT that are not being cash inflow or cash outflow, right? This is very similar to the statement of cash flow. Remember that you adjust for this item in the indirect method, right? Because what you want to have is the EBIT that is related to cash only, right? All the revenues related that are cash based, or the expenses that are cash based, and that's why we subtract this element. You're also going to subtract the CapEx, and we're going to touch in a bit about the other, right? And the other is related to those non-cash items that are embedded here, right? And we're going to space on that later. Okay, let me take a moment here and talk about what is the typical thing that you are going to see in some how would I call it, plain valuation, right? A very simple valuation, right? If you do not have enough information, if you want to have a quick number, right, on here, what most people or practitioners do, right, in order just to have this element taken off, they assume that this increase in net working capital, right, is going to be close to zero. You basically assume that to eliminate completely that element. And what other people assume is that the depreciation number is going to be identical to capex number, right? So it actually simplifies the calculation significantly. I'm not saying for you to do that, right? But if you do not have information, you have to present the number in 5 minutes, right? You want to go into the EBIT number, multiply that times 1 minus t, check if there are non-cash expenses over there, and that's it. And that should be it. Let me touch base here on changing deferred taxes, right? So here it's, and that's the correct formula, right? You should be asking for deferred taxes. And what are deferred taxes in your financial statement, right? It means that in some situations you have paid more than you should, or you have paid less than you should to the tax authority, right? Remember, we have a financial statement, right? And it's a financial account. But there's also another statement, which is a tax statement, right? With tax accounting. Right? In tax accounting, you may actually have accelerated depreciation in some cases, right? There are some items that are expenses that cannot be considered as expense for tax purposes, right? You cannot deduct those expenses. You cannot eliminate those expenses from your income, from your earnings, right, in order to pay less taxes, right? So in that sense, there are going to be some differences between your financial statement and your tax statement, right? And changing deferred taxes, if we want to go to a financial statement, it's going to be on the asset sides, right, and on the liability sides as a whole, right? You're going to be seeing in both elements at all as part of our typical calculation. What happened? Just screen, 1 second. Okay. So as I was saying, there's going to be some elements related to the taxes, right, on both sides, right, on income statement, and it can be based on what we have been calculating. Let me just scroll this back up here and use this financial statement from Ferricor, right, to exemplify what I'm talking about, right? So there's going to be some elements here. Let me just show you here. Right? They're calling impuestos a ganancias. That's the tax payment, the income tax payment, right? When they talk here, ganancias is not related to market values elements, it's related to earnings, right? So we're going to have here that there's an asset on these deferred taxes, right? That is going to be 198 on the asset side. And there's also on the liability side, right, another element, right, related to those assets. And everything is in note 16, right? And let me just scroll down, right? And let me quickly mention, for most of the cases, right, practitioners do eliminate that element in your forecast, the deferred taxes. Why? Because it's going to be very difficult for you to come up with how they're going to be treating those deferred taxes into the future, right? They just assume them to be zero, not impacting the cash flow, and you're still paying taxes, right? We are talking about taxes that have been paid in advance and taxes that have not been paid at all. Let me just quickly slide this here to 16. Forgetting the page number is 70. It is right over here, right? So there's going to be an asset, as I was saying, related to this element, right? And it's based on, okay, we're going to have some expected reversion on the payments, right, that we have here, and what we expect these taxes that we had paid in advance, right, to be reversed, to be reduced, right, and the claim that we may have against the tax authority, right, at all. And you realize that the net number, right, the number that we should use the net number, obviously, I'm talking the first tax payable, but obviously what I meant is, okay, you should use this number, the liability number, minus the asset number, right, to arrive to a number that is on the liability side, right? And we should come up with the effect that that's going to have. And it's going to be minimal because it's going to be the change, right? It's not going to be the 11 million that appears here. It's just going to be the difference that we have here at all in our calculation. So coming back here, right? As I was saying, we are going to drill into each one of these elements and not going to drill much into the change in deferred taxes because it's going to be a lot more complicated for you to figure that out in general in your calculation. And once again, and just to recap on weighted average cost of capital, it's going to be the weighted average between the cost of equity and the after-tax cost of debt, right? You calculate the cost of debt and come up with the adjustment of 1 minus the tax rate. Hey, which tax rate should be using here? You should be using the marginal tax rate, right? Not the effective tax rate. Why? Because remember, the weighted average cost of capital is going to be used to discount all those future cash flows you're going to have in the 5-year forecast or 10-year forecast that you prepare, right? And in perpetuity. And if that is the case, you should not assume that the current tax rate, right, or the actual tax rate that you have in the last year, right, that the effective tax rate should be applicable, will continue to be the same, right, in this calculation. Other word of advice, the numbers we are going to be talking here, cost of equity and cost of debt, are going to be market value rates, right? We're going to prefer to come up with that. Obviously, if the company do not have any bond in the market, have not issued any bond, it's going to be a lot more difficult to arrive what is the cost of debt for that company, right? We're going to drill into that later on and try to come up with alternative ways, right? But in some situations, you may end up using the information in the financial statements, right, related to what is the interest rate on the debts that we have, right? That's going to be the interest rate on the debts, the average, the weighted average interest rate on the debt that we have. Okay. So capital cash flows, as I was mentioning before, right, and I just want to scroll rapidly over these, are going to be applied in special situations, right, where we have a high level of leverage that is also beneficial because it's generating a high level of interest taxes, right? So that's the good thing that you have coming up from a significant amount of leverage, right? But as I was saying, the way we should calculate the value of a company when we are facing these high situations, right, should be using the discount rate, should be using for the discount rate the required return on assets, right? And we're going to arrive into that later on. The difference between the free cash flow and the capital cash flow is just adding the interest taxes, right? And it's going to be something very similar if you remember to the adjusted present value methodology. So as I was just mentioned before, right, the adjusted present value methodology is discounting the free cash flow at the required return on assets and discounting the interest taxes at the required return on interest taxes, right? If you are in a situation with high leverage, the required return on interest taxes turn out to be the required return on assets. So since the numerator is the same in both summations, you can sum the numerators, right? And you come up with the free cash flow plus interest taxes, right? I'm missing an I here. It should be, should be equal to the capital cash flows, right, as a whole. let me scroll that down and quickly continue, right? The thing about the cash flows, right? We're going to see that in following sessions. I want to describe it now is that it actually uses actual taxes, right? It's using the effective taxes, the projected tax payment. And what is important? Why are we saying that capital cash flow should use the taxes, right, that are forecasted? It is because when you are facing this situation with high leverage, right, it is highly likely that from accounting standpoint, earnings before taxes become negative, right? Imagine, right? You are transforming the company, you are getting a lot more leverage than you should, right? From a free cash flow standpoint, you're better set. From a cash flow generating standpoint, right? You are capable of paying all the expenses, all the cash related expenses, right? And paying the interest expenses and the principal payments that are required, right? But even if you have that, right, EBIT or earnings before taxes can turn out negative, right? Because there are non-cash expenses, right? So coming back here, for instance, right, when I'm saying that, what it is, here it is, right? So imagine that I'm having a situation where I'm increasing significantly leverage in for our friends at Ferrico, right? What I'm basically saying is that these financial expenses, right, that's interest expenses are so high, right, that are higher than the EBIT number. And if that is the case, the earnings before taxes that appears here can turn out to be negative. And why is that? And despite that, I can still be paying everything from a cash flow perspective, right? Remember that there are expenses here, depreciation, the first one, right? That is non-cash related, that are increasing the expenses and reducing the EBIT number, right? So coming back here, what I'm trying to explain is that when we are going to be discussing about cash flow payments, capital cash flow payments, right? Capital cash flow calculation, we are going to be focusing on a number that incorporates the projected tax expenses, right? Because in some years, it may be the case that you do not pay taxes, right? That's part of the truth. And I'm putting here an alternative formula to calculate capital cash flow, right? We are going to work it out later how to reconcile both formulas. But as you can realize, this is very exactly free cash flow plus interest tax. It's going to be identical. This formula that I have over here, if we use the actual taxes that are calculated, right, it's going to be identical to the formula of free cash flow plus interest tax. It's nothing more than that. Okay. So once again, capital cash flow should be used for situations with high leverage, situation in distress, and situation with bankruptcy that we are going to be facing. Let me drill into equity cash flow, right? Just to recap on what we were saying before, right? Before jumping into our Excel session. And let me upload that in a bit. Okay. So for the equity cash flow line, right? As I was saying, we should try to measure, right, all the cash flow available to stockholders, basically shareholders, right, after paying the debt holder. So you should be considered here in these debt cash flows, right, all the interest and principal payment that we're going to be having. It's basically that calculation. You should be taking into account all those payments that we have, right? And I'm saying here, calculate the capital cash flows and deduct the cash flow. This is identical to come up with how much you are going to be giving, right, to these to these debt holders, right? And just put it better so everybody can understand, right? This is equity cash flow, right? It's equal to free cash flow plus the interest tax flow minus the debt cash flow. I realize it's not that clear right now, but it makes more sense here if you figure it out, right? It's your typical free cash flow that you are going to be using to value the company, right? You add the interest tax flow, right? You are adding the interest tax flow because you are recognizing that the interest tax flow generates a positive effect that you're not paying taxes, right? For those interest expenses, right? And then you are going to be subtracting, right, all those interest payments and all principal payments that are to the debt holder. That is going to give you, this calculation is going to give you the money that is left to the shareholders, right? Whatever money is going to be left to the shareholders. And we are going to be coming up with, let me just write this bit. Look better that way, right? We're going to be coming up with these calculations, right, of equity cash flow out of our typical operating cash flow, right? Realize that debt cash flows are obviously more secure, less risky, our free cash flows, right? And obviously than the equity cash flows, right? And that's the way we are calculating. And the way we are figuring out, right, these equity cash flows are going to be discounted, right, at our typical required return on equity from our typical capital asset pricing model, right? Equity cash flow can also be estimated, right, using this formula that I'm pointing out here. And logically, many of you have already realized that this is identical to the capital cash flow formula, except for this change in debt number, right, that we have over here. And basically, it's letting you know how to come up with the values that are going to be presented or given to the shareholders into the future, right? As we're going to be seeing. I have already said this, I have already said that is return on equity, and I have already mentioned that the value that we're going to obtain is the equity value. When are we going to be using this equity calculation, right? So there are some particular evaluations that are really complex when analyzing these type of companies, right? And the first one is the financial institutions, right? The problem of using free cash flows, right, that we are going to be, here, let me just put it down here. Should be this one, right? The problem of using cash flows, right, it's going to arrive to the total enterprise value of the company that we have already mentioned, right? And then try to deduct from that the debt value of the company to arrive to the equity value. In a financial institutions, that debt value that we are reducing, right, is actually part of the business. Part of the business of the financial institution is getting that necessary financing, right? And I don't mean talking about here savings account or term deposit account, deposit a plazo, right? Also mean getting financing from bonds, right? Or getting financing from abroad financial institution from other countries, right? That's part of the business. That's part of getting the necessary financing in order to lend money to the other side, right? To the asset side, to the potential creditors, right? What is obviously happening is the business of the bank, the business of financial institution, is give money, right? And money becomes the good that they are selling, right? So they are buying money at a certain price, right? That's the liability or that side of the company, and selling that money, right, to the other side at a higher interest rate, right? And that's part of the business. So then it's becoming a lot more difficult to arrive to this enterprise value that we have been mentioning here. And it's better in the case of financial institutions, right, to try to come up with the value that we have for these cash flows in the coming years. So it's gonna be to us try to calculate, right, these equity cash flows as free cash flow plus interest tax minus debt cash. Try to calculate this equity cash flow as this formula and come up with a better estimation of this equity value in general. And it's gonna be a lot harder than usual. So last but not least, just a word of caution that we have been explaining here, right? The pros and cons in general. We are going to observe that in most cases, adjusted present value that allows you to model correctly the interest tax flow, right, is better than using the weighted average cost of capital. Most of you probably have already done some estimation, right? And we're going to be working on that later on. But if you use weighted average cost of capital, most of the time forces you to have a single you can actually try to estimate different WACs for each one of the year, right? And kudos if you do that, right? It's a more accurate approach in order to estimate correctly the interest taxable benefit, right? Debt is changing over time, right? But that is right. Weighted average cost of capital that's not necessarily going to give you a correct estimation if the company has a high leverage number, right? So LPV is preferred over WACC for those reasons, right? And obviously WACC is preferred to equity cash flows, as I have been saying all along, right? It's a lot more easy to make mistakes in the equity cash flow calculation due to the increases in debt and cash flow that you will probably estimate it that may occur over time as a whole. Okay, give me 1 minute to get some water and be back in a Okay, let's continue. Let me upload calculation here. I think I have a minute. Save. No, save. For those of you who arrived late, there's a seminar or conference on Friday 13, right, with some recent graduates, that's the correct way to put it, right, which are from Nexus Group, Goldman Sachs, right, JP Morgan, right? Well, Jose Gabel is not recent, right? He has several years outside the university. Also, Maria Angelica Meneses from Rodrigo Studios, right? Rodrigo Elias Medrano, lawyers that we have over there. Sorry. Let me just email me from SAR. I was asking what is the due date to put your grades, right? In order to allow me to put what is the due date for you to deliver the examination. They have given me a lengthy email that I need to read. It's gonna take some time. So I'm gonna load the directions or document with the directions for the final project, right? For your final project of this seminar. After class, after I read this and I'm capable of putting the due date as I understand it. Let me check it out if I'm showing the correct road. No, I'm still here. Okay. So this is what we were discussing last time, right? We were talking about capital cash flow calculation based on the information that we have in Federico, right? The audited financial statements that we have here from Federico, right? And I already went along some of these elements, right? I told you that for the EBIT number, right, we should be using utilidad operativa, operating income, right? And I'm now going to start showing, first of all, the calculation as if I'm not using the historical data, right? And so here I'm assuming marginal tax rate, right? And this is a typical way you will do for your forecasting, right? Let me just increase font because it's becoming very small over there. I imagine you can open it in your computers to show it better, right? And follow me through when we're doing this. But I wanted to highlight some of the key points that we are mentioning here, right? So the first part, the first section that I'm going to discuss, or the first try that I'm going to do, it's okay, let's do this, right? Assuming marginal tax rate, which is the same that you're going to use when you're forecasting 2020, 2021, and so on, right? Uh, and as I said, we're going to be picking up, right, the operating income that appears here, 60 million, sorry about that. I'm going to be using the marginal tax rate of 29.5, right? And I'm going to be using the EBIT 1 minus T calculation to arrive to that first element in the free cash flow line, right? I'm not going to focus on deferred taxes, and I'm adding back the depreciation. By the way, you know why I'm not subtracting depreciation? Why I'm not doing this? Give me 1 minute, please. Why I'm not doing? Why is that formula trying to do this in general? Some of you already know the answer because I've taken additional courses, but what's going on? Trying to copy this down and it's not helping me at all. Why is not free cash flow EBITDA? Since I'm adding back the depreciation here, why I'm not starting with EBITDA and I'm starting with EBIT? Can I start with EBITDA? It's going to be the same, right? Depreciation is not a cash item, right? It's not a cash expense, right? So I can start with EBITDA, right? Or not? Okay, suficiente tiempo callados. Who knows this? Martín Alonso, you should know this. Are you there? Tengo un problema de tener las cámaras apagadas. Neil Verayake. La pregunta es por qué no empieza con el free cash flow. Total, la depreciación no va a considerarse, ¿no? Y por si acaso, yo he visto algunas validaciones que empezaron con EBITDA y no corrigieron nada. ¿Cuál es el problema de empezar con EBITDA?
Bueno, el problema que yo veo es que no, no está ajustando por la tasa o por los intereses, el efecto de los intereses.
A ver, vamos por partes. Y déjenme arrancar en español porque esta parte sí tienen que entenderla bien. El free cash flow se centra en los flujos de caja. Sí, gracias, Sebastián. El free cash flow se centra en los flujos de caja a la empresa. ¿Sí? En free cash flow no van a tener absolutamente los intereses, los gastos por intereses. No pueden tener los gastos por intereses. ¿Por qué? Porque los gastos por intereses es lo que tú le pagas en rendimiento a tu acreedor, ¿sí? Al banco, a la entidad financiera, al tenedor del bono. Eso es lo que tú le pagas. Eso no debe estar en el free cash. Nunca tiene que ver el free cash flow de gastos por intereses. Y justamente les mencionaba la clase pasada, que muchas veces, si se van al estado de flujo de caja, y mostré otro, pero acá Ferreiro, el equipo de, este es Price, ¿no? Es igual, pero es Price. El equipo lo hace muy bien, pone intereses pagados acá, en la parte de financiamiento, pero muchas veces lo ponen acá en gastos de operación, actividades de operación. Creo que mostré Telefónica u otro que lo tenía ahí. Muchas veces lo ponen ahí y sobre todo en el esquema de método indirecto. Pero nuevamente, volviendo acá. ¿Dónde está mi Excel? Primera cosa, el free no tiene nada de intereses, ¿sí? No puede tener nada de intereses como parte porque es lo que va a ser la generación de valor por flujo de caja que van tanto para el accionista como para el deudor. Entonces, si ustedes le suman o le restan el escenario, están considerando lo que va para el deudor. Y esa no es la idea, no van a poder hallar el valor correcto. Como bien posteó, me olvidé el nombre, Sebastián. Gracias, Sebastián. Sebastián Valencia, en este caso. El tema es, este depreciation que está acá, que está siendo sumado, ¿sí? En realidad, acá está generando un depreciation tax shield, ¿sí? Hay un escudo fiscal por la depreciación. Entonces, esta fórmula de acá, empiezas en el BID, está mal como está, ¿sí? Pero se corrige, y también lo van a ver en algunos libros, ¿sí? Sí, ok, yo hago EBITDA 1 menos TC, pero hago depreciation times 1 minus TC. 1 minus T. What is that? ¿Qué es lo que está pasando? Oh, sorry, depreciation times T es. Input asterisk. ¿Qué es lo que está pasando acá? Está recogiéndose el efecto del escudo fiscal generado por la depreciación. Empiezo con EBITDA, ok, está bien, no quieres considerar el EBITDA acá, pero estás considerando el escudo fiscal de la depreciación. Dense cuenta cuál es la diferencia, ¿no? Porque ustedes tienen, déjenme salir del momento en medio de los, quiero ir al, me está dejando entrar los cuadrados. ¿Cómo? Realize this, right? You have EBIT, right? And EBIT is going to be EBITDA minus depreciation. So if you go ahead and do 1 minus TC to both sides, right? The thing you're going to be getting, right? 1 minus T, let me do that, right? It's going to be EBITDA 1 minus T, that's the number that the first value that we have, minus depreciation 1 minus T, right? And obviously, if we continue with the math, right, we're going to realize that this is going to be minus depreciation plus depreciation times T, right? And we just rearrange the numbers or the variables here. Let me just clarify this. Sorry about my obsessive disorder that forced me to put everything in capital correctly, right? EBITDA minus T plus depreciation, right, is going to be EBIT 1 minus T plus depreciation is going to be EBITDA 1 minus t plus depreciation times t. Right? So you are recognizing this depreciation tax shield, right? And and this is important, right? Because you are not going to be paying tax though because of those depreciation values, right? That we are going to be having. So if you observe that is some calculation of free cash flow is starting with EBITDA, look for this, right? Look for the depreciation times T, the depreciation tax shield, right? That should be recognized. If it's not there, the calculation is wrong, right? We also going to realize, right, that in here, inside the EBIT number, this, let me get back here, guys, a minute, esta utilidad operativa, acá, right? There are some items here in selling expenses and administrative expenses, right? That, oh, this is too much, sorry, 150. There are some items here, right? That are non-cash related. Remember, what you want to come up with is the cash flow, right? That's why we are going to be adding those items in a bit, right? At the end. And what's happening, obviously, is that similar to depreciation, right? Those items are generating their expenses, right? They are generating a tax shield, right? That's why we did not eliminate them initially. We leave the formula as the first one that I have here, this one, right? Let me just right? Start with the EBIT, and then we add those elements back, right? If they are not generating a cash outflow or a cash inflow, right? Depreciation do appear in the original formula because it is a non-cash expense that normally appears here in EBIT, right? It normally appears in a financial statement or an income statement. Okay, so let me scroll down a little bit, right? So we start with the EBIT once again, apply the EBIT 1 minus T, I add in the depreciation, and once again, just for everybody to remember where am I getting depreciation. As I told you, this was a statement of cash flow from an indirect method, right? The depreciation and amortization would appear as a line over here, the typical way. But if they're not, right, we have that information in the notes, and I'm going to note 10, right? Note 10 is going to tell me right here all the assets and liabilities, all the PP&E. Remember, we have land, we have buildings, we have machinery, right? Transport units. And I'm going to sort it out this to the left. And there is a note here that tells me how much it has been expensed in depreciation, right? In cost of goods sold, in selling expenses, in administrative expenses. If I go down to each one of these notes, we are going to observe these numbers, right? These same numbers. But here they are consolidated for presentation purposes, right? So this was the first number. If you look into the Excel, right, there's 130,213 here. And the second number that do appear here, 55,748,000, is coming back from the depreciation of these other items, right, that are the operating leases, right? Here, activos por derecho de uso, right, that we have right around here. And we have that information here about the amortization of these assets, right? That the depreciation of these assets that we should be considering as part of our calculation. Once again, these are elements that are included in notes 18, 19, and 20. Let me scroll that down if you can come quickly. And here they appear as depreciation in J10K with the 98, and depreciation here in 10J, 63,287. This, once again, are values that are included, right, in the expenses. And just scroll down. In the expense value, right, that we have here in cost of goods sold, right, in this number, and in sales expenses and in administrative expenses. So they are included into my EBIT number. That's why I'm putting them back here. So that means that the depreciation tax shield has been calculated when applying this EBIT 1 minus T. It has been included over there. Okay. Next, I separated this amortization, right? But normally you should put them in the same line. It's depreciation and amortization of intangibles, right? Why am I adding the amortization of intangibles? Once again, an amortization of intangibles is a non-cash expense. It's going to be included in my EBIT number, right? And I'm adding it back to recognize the fact that it wasn't a cash outflow. But this amortization do generate a actual, right, that I'm considering here when I calculate even 1 minus T. Let me get back to my amortization just to show where I'm getting that, right? Once again, this is number 45, right? That's going to be the PPI that we saw before, right? It's run down over there. Note 11, right? You are going to be having this intangibles number, and it's going to be similar to what you had on the calculation for PP&E, right? You're probably going to see intangibles similar to software, right? Here, right here, programas de cómputo. As you realize, actually, that's the highest value as of the end of 2019, right? 240 million. That's the value of your software items, right? But there are going to be other elements, right? Like a brand, right? Client relationship that put it out here. Relationship with suppliers, that's also different. Agreements of non-competition, right? And these numbers that I'm seeing, relationship with clients, relationship with suppliers, agreements of non-competition, right? They normally appear in a financial statement after an M&A transaction, right? What they are doing here is, okay, there's some intangible value of the relationship with clients, right? How much money I can sell to these clients compared to others, right? And they try to value this somehow. Similar for the providers, for the suppliers, right? And we have over here, and identical with this agreement of non-competition, right? An agreement of non-competition is not an agreement with a competitor, right? Because that will be collusion, right? That will be a cartel, and that's a strategy that is prohibited, right? And actually sanctioned by competition authorities, such as in the copy. An agreement of non-competition is similar to the ones that are signed in an M&A transaction, where you agree with the seller that they are not gonna compete with you after they sell you the business, right? So if you call the Linley transaction, right, when Inca Cola was sold to Arca Continental, one of the agreements or one of the elements is selling agreement that they had. It was a clause that prohibited our friends from the Linley family to go on and create another bottling company, right? That's gonna compete with Linley Corporation, right? With Inca Cola Corporation that was recently acquired by Arca. That is typical, a typical non-compete agreement in any M&A transaction, right? Similarly, when Santander was sold to Banco de Crédito, right? We're talking back in 2003, right? Santander, the first time Santander was in Peru, because right now Santander has come back, right? there was a non-compete agreement for 5 years, right, that prohibited Santander to open a new bank or acquire a financial institution in Peru, right, during 5 years. That was the tenor as a whole. Coming back in our calculation, right, once again, what we want here is to have the expense, right, that is related to this amortization of intangibles. And once again, we have it right here, right, of 15,863,000, right, that is included once again in the cost of goods sold, selling expenses, and administrative expenses, right? And that's why I'm putting that in this line, right, as amortization of intangible. If we can look at it, it's going to be the same number that we are going to be having at all, right? I'm going to later refer to this other element, right, that has appeared here, which is called crédito mercantil, right? And this crédito mercantil goes exactly with what we just analyzed here, relationship with suppliers, relationship with customers, right? And non-compete agreements and brand, right? Brand value that we're going to analyze in a bit, because any impairment, the crédito mercantil, by English this is called goodwill, right? And impairment to goodwill, right, is going to generate an expense. But once again, it's an accounting expense, right? It's a non-cash expense. And we should consider adjust for that, and we are going to adjust that in the other bit. So let me get back on track. We're saying, okay, we have calculated the EBIT, we have calculated 1 minus T, we have come up with depreciation, amortization. Let me talk about CapEx, right? And the first thing people make the mistake is, okay, let's quickly go over here. Yes, I know where the CapEx is, right? And it's going to be in the statement of cash flows, right? So let's call it up. Here it is. From activities from operations, right? Activities from investment, yes, this, right? 2,555 million, right? And people tend to use this number, right? Agree, if you do not have time and your VP is telling you, yes, you have 10 minutes to come up with the number, right? And you do not have any more time than that, right? Yes, I agree. Go ahead and pick it up that number, right? But the correct value should be analyzing each one of the different lines that they show for investment, right? Because our friends from accounting, right, tend to consider here in investments in the statement of cash flows some elements that we as financiers are not going to take into account when coming up with the free cash flow. Why do I mean by that? Obviously, buying PP&E, buying property, machinery and equipment, right? It makes sense. That's CapEx, right? Acquisition of intangibles, right? That usually refers to buying software, right? Spending in software, right? You can consider that if you are considering intangible amortization. You can consider that as part of the CapEx portion, right? But then come this weird thing, right? That normally do appear in the investment section. That is, okay, this is a portafolio inversion. This is an investment in an investment fund or addition to an investment fund, adding capital to an investment fund or mutual fund, right? And there's also the liquidation or the cancellation of this investment in funds, right? And we're going to drill into those in a bit, right? And also selling of investments, right, that you may have or not. And these are the portion that I do not agree with, right? You should consider as part of the CapEx, right? You do realize that these elements that I'm mentioning here, the investment fund, putting money into investment fund, putting money into a mutual fund, right? It's more related to how do you manage the excess liquidity that you have, right? Because if the company is going to have some cash number, 4.2 I'm looking for, right? If the company is going to have some cash number they abide with, right? What is going to occur is that if you have some excess cash, they're not going to be paying dividends immediately or repaying immediately, right? Sometimes they prefer to keep that money on hand, right? Just in case just in case some opportunity arises or some requirement arises for that excess cash, right? Here they are showing us what are the balances that they have on all the different banks, right? Here in Peru and outside Peru, right? As you can realize, they operate in several countries, right? And that's normal for a company like Ferrycorp, right, to have several accounts in several locations in order to be dealing with different suppliers and customers, right? And then there is this issue of what you're going to be having on funds investments, right? As I was saying, these are some excess cash, right? This is 5 million soles, right, that they had in excess, right? And they have subscribed since this participation shares, right, in Credifondo, right? In un fondo conservador liquidez soles, which is a fondo that you can easily sell the shares, right? It's a fondo mutuo de inversión en valores, that's what it says over here, right? That you can easily sell and you just want to have a little more profitability over that excess cash, right? If you keep the cash in your accounts, it's not going to be generating any extra value. Then you may decide to put in an investment fund or a mutual fund, as I'm mentioning here, right? And that's going to be generating these elements that I'm considering. They invest in credit fondos, they invest in Sura, right? Ultra cash means it's very, very, very liquid, right? That's the way they have tried to highlight it. And they usually invest these mutual funds in deposit accounts, right? Or in small certificados de depósito del Banco Central de Reserva o certificados de depósito de alguna entidad financiera, el Banco Ripple and so on. Try to diversify. If you diversify, that's fine, right? So what I was mentioning is for CapEx purposes, right? We're not gonna be using the whole number that appears here, the 255,000. We're gonna be picking up only the first two elements, 186, 132. I think I use another number, the 78,000. I add something up. No, to the I made a mistake. Selling of investments, it's from the selling of investment is not it's not an intangible, it's not a PP&E. They are selling investments in particular subsidiary they are presenting over here, right? Shares in other subsidiaries in their balance sheet. Let me just show you where they are putting that. That shouldn't also be considered as part of your normal calculation of free cash flow, right? Inversión asociada sin negocio conjunto. That's what they were selling, right? Estimation that we have. Okay, and that's why it increased, right? They actually put more money in their asociadas and the subsidiaries that they have. Okay, any questions so far that we have been analyzing this? This is direct, simple, I believe. What are the key elements or doubts that you should be arising here, right? Okay, I have been saying you are not going to be considering certain elements. Let me just scroll this down to your side. Certain elements on the statement of cash flow, right? Does that mean that we are not going to arrive to a similar number that they are arriving, and we're not going to arrive to operation plus investment identical to them? No, we're not going to be arriving to the same accounting numbers, and you shouldn't, right? You shouldn't expect that to occur, right? The change in cash, yes, that's going to happen, right? But your estimation is not going to have to reconcile with the accounting values, right? You do not have to have that consideration. Sorry. Okay. I wasn't sure it wasn't presenting properly. Okay. So let me get back to the last. Oh, yeah, I forgot about changing net working capital, right? We talked about that several classes ago, right? and I did mention that you are going to be facing this situation, right? The typical net working capital that you have seen in accounting, right? It's current assets, total activo corriente, minus current liabilities, total pasivo corriente, right? And in immediate told, no, that's not the way we're going to be calculating this, right? That's not the way we're going to be analyzing this element, right? Because there are some inconsistencies in that calculation. And the first one from that perspective, right, is that we are incorporating here cash, right? You shouldn't be considering cash, right? The net working capital that you should be taking into account, right, are those accounts related to the business of the company, right? We are being focusing on cuentas por cobrar comerciales, otras cuentas por cobrar, and existencias, accounts receivable or accounts receivable inventory. Is investment in shares and investment in funds, right? Those that I mentioned here that are short term in the current asset portion, right, should be used, right, to net out, should be considered as excess cash, better said, and should be used to net out the debt. That should be arriving to the net debt with that. Let me move over here on the liability side, right? The first thing you shouldn't be considered as current liabilities for net working capital calculation, right? It's the debt obligation. The short-term debt obligation shouldn't be there. Neither this is liabilities from rent, right? We should be focusing on accounts payable and other accounts payable, right? Realize that I'm neglecting this element, pasivo por impuesto a las ganancias, which is a deferred taxes line. As I said, those should be treated separately, and we are not going to be considering those. They're mostly not considered. So coming back to my Excel spreadsheet, right? I have here the accounts receivable, accounts payable, and so on that we should be counting out, right? And if we sum these, sorry. If we sum, sorry. Yeah, it works. We sum the asset numbers, the asset variables, if we want to talk about, and subtract the liabilities variables, all the payables, right? You are going to arrive to the net working capital, right? We have one for 2018 and another one for 2019, right? And the change that we're going to observe, right, I'm subtracting one minus the other, is going to be a change in net working capital. Once again, why are we doing this? We're doing this because here on EBIT, there's a revenue line. There's a revenue line that is related to accrued values, right? That's accounting revenue. In order to come up with the cash flow that from the cash flows from revenues, the cash inflows from revenues, right? We are adjusting these accounts receivable, right? That is exactly las cuentas por cobrar a los clientes. Similarly, in this number, right, there's a cost of goods sold for the materials or goods that have been, or services that have been provided by suppliers, right? And similarly, we are adjusting here accounts payable, right? In order to arrive to the cash basis expenses that we want to consider here. The change in the working capital, realize the net working capital was positive, right? The change was negative. Since the change is negative, that generates a positive element in my free cash flow calculation, right? If you decrease the net working capital, it means that you have more cash. That's the element that we are putting here. Okay, let me go on to the other element. I wanted to drill this with you, right? Because for many times people do neglect these items, right? And in reality, they do affect your calculation for free cash flow, right? And then we're going to drill with the fact of taxes at all that we are familiar, right? As I said, there's an other element, right, in your free cash flow calculation. Let's go back to the formula. right? The typical formula, EBIT1 minus T. I'm neglecting changing deferred taxes. Depreciation, increasing net working capital minus CapEx, right, plus other. Right? If we are saying that, right, that other line, what it basically says are the non-cash income and expenses, right, that we should add back if they are an expense or subtract, right, because they are non-cash related, right? So remember, if there's an expense, the plus, right? If it's an income, put a minus, right? Once again, non-cash. Remember, these are flows, right? Changing the working capital was stocks, right? Why we had to calculate the change. Here, these are flows and they are cash. Now, where should we look for that? Where should we be aiming our analysis, right? We should be focusing on the elements of EBIT, right? The revenues, the cost of goods sold, the selling expenses, and the administrative expenses, right? So if I'm going back over here, let me put 450. Oh, let me switch this back to the left. Is this a little bit? Here in note 18, right, we have all the information related to revenues and information related to cost of goods sold. Right? Regarding information related to revenues, it does appear that all these elements, right, are cash related, right? Remember, some of these are not going to be paid immediately in cash, right? They're going to go to accounts receivable. But when you adjust for net working capital change, right, then you are recognizing, right, the elements, the revenues that are not being paid in cash immediately. That's the way we are managing this. I'm not looking for that, right? I'm not looking for the effect that is being adjusted by net working capital. We're looking for those expenses that are accrued expenses, right? Gastos devengados, gastos que, pero que no generan salida de caja. That's what I'm looking for, right? And we have, well, obviously, buying inventory, it's an item that it's going to be in part cash, another part is not going to be cash, but it's going to be adjusted by labor, right? That's basically plant expenses, right? Here we have our depreciation amortization, and these are the ones that I'm looking for, right? Desvalorización de existencias y recuperación. What does that mean, right? That means impairment to your inventory, right? A reduction in value to your inventory and the possibility to recover that inventory somehow, right? So accountants, right, require that you evaluate if your inventory, right, is past due, it cannot be sold. If it was an item that has a certain life, it's not already eatable, it's already useful, right? And that's what is called desvalorización de existencia, impairment in value for your inventory. Requires logically is if you perform something and some way, you are capable of recovering that inventory, you're capable of selling that inventory somehow. So we're going to be focusing on this, right? This reduction in value for inventory and recoveries, and also on this one, right? Desvalorización de flota alquiler, which is also going to impact. Right? So the values that I'm going to be focusing is there's going to be an expense of 26,863, a recovery of 30,322, and an expense of 8,281, right? And that's what we're going to put in here. And that's why I have put in here reduction in value, recovery of value, right? There's going to, as you have an impairment, there are going to be some items that are a reduction in value, right? These are expenses, right? The reductions in value. So we are going to be registering them, right, as positive numbers. I'm missing one digit here, right? And the recovering value, right, is going to be negative number. And once again, the recovering value is an accounting adjustment, right? We are increasing the value of the inventory in this case, right, due to some accounting change, right? We probably had reduced the value before, and now we are recovering that value. Similarly, we're going to do the same in all the other elements, right? And here comes a friend that I wanted to show you, right? We have gasto personal, that makes sense, servicio personal por cero, right? Our depreciation, right? And that makes completely sense in our calculation. And there are two elements that I want to highlight. This one, estimación por cobranza dudosa, right? These are the provision for bad rates that we have given to our customers, right? And this other line, desvalorización de existencias. Remember, amortización de intangibles, amortization has already been taken care of, right? So first of all, let me talk about desvalorización de existencias. Obviously, this is in the selling side, right? It's an expense, right? And obviously, in my calculations, should be adding here as a reduction in value, right? Those 10,569, right, that we have over here. That makes sense, right? But I wanted to highlight why I do this, right? Because usually students do incorporate this provision for accounts or for bad accounts, right? Provisión para malas cuentas, provisión para cobranza dudosa, right? And they double count the effect of them. Why I'm saying they double count the effect of them, right? The issue is the following, right? When we calculated the change in the working capital, right? We consider the accounts receivable numbers. And the accounts receivable numbers, let me just scroll back up to the balance sheet. The account receivable number is net of that element, right? That's the usual thing. The cuentas por cobrar comerciales number that appears here on 6 is usually presented net of those elements, net of that provision, right? It doesn't show any other way. So when we calculated the difference between one and the other, right, between cuenta por cobrar comerciales from 2018 and 2019, we implicitly already consider that provision for bad accounts, right? We are already taking that into consideration when having that calculation, right? That's in 6. Down. Note 6, right, which is, show you the note 6, right, it goes over the whole way, cuentas por cobrar comerciales, right, do consider that estimation for doubtful account, for cuentas de cobranza dudosa, malas cuentas, right, and it's taking that already into consideration, right. Remember, this is the stock, right, so when we did this difference between these two elements, 1,000 million, 195 million, 47,000, and this 1,000 million, 140 million, right? We took into account, we already considered the change in the provision for doubtful account, right? So when I was mentioning we shouldn't be using this number, right, in an additional adjustment. I scroll too farther, right, in order, this estimación para cuenta por cobranza dudosa, we shouldn't be incorporating it here in order because we already counted back here, right? It will be different if you had not used the net accounts receivable and you have used the gross accounts receivable, then it does make sense to make the adjustment. Remember, that provision para cuenta por cobranza dudosa is included here de utilidad operativa. Let's scroll that down fast, right? And we go over here, right? Gastos administrativos does not have any of those elements that I have mentioned. But there's no problem with all of these elements are cash related, right? And can be adjusted by cash. And personnel expenses are not going to have any of those items that I'm mentioning right around here, right? As part of our typical estimation at all in the calculation that we have, right? Any questions so far? Okay, so just to wrap it up, right? These are, I'm going to use the font. So your free cash flow estimation is going to be this. It's going to be your EBIT plus the depreciation plus the amortization, right? Minus the CapEx. Sorry. Let me put that positive, right? Because otherwise people are going to get confused on what I'm doing. I change this to a positive number. Because what happens is, it has happened to me before, people get confused with the double negative that usually shows over there, right? So EBIT 1 minus T, positive, depreciation plus amortization, minus CapEx, minus the change in net working capital. The change in net working capital here should be identical to the change in net working capital that we have here, right? Negative, yeah, it's better to do it this way. And plus the other value, right? Once again, this is other, is a non-cash expense that is included here on the EBIT line, and we keep it on the EBIT line because we want to have the tax, right? Realize that in our calculation, this is the depreciation tax that is being generated, right? Similarly, here we have several tax shields, right? On depreciation, we are getting a 55 million tax shield. From amortization, 5 million, and from these non-cash expenses, 4.5 million at all, right? And then it means that the numbers are relevant for us to calculate that. Okay. So I already come up with the free cash flow that you probably some of you are already familiar with. Let me just make a twist here, right? Because I said this was forecasting, right? What's happening with historical? We put that there. And then I already know where to find everything, by the way. Let me erase all this mumbo jumbo that I put. Actually, you focus on historical. What should be a curve? We're using historical, this number shouldn't be 29.5. Immediately, you're going to be saying, hey, you should be using the effective tax rate, right? You should be putting here the effective tax rate. That's a possibility, right? You should be going, hey, you should be aiming, scroll back up, I think it's 5, if I go correctly, it was 6. You should be aiming from utilidad de impuesto a las ganancias is 388,039 and applying those 141,603, right? So 141,603 and you should be using 38039. This is income taxes. right? This is earnings for taxes. Right? And people are going to say, okay, let's calculate the effective rate, which is the income taxes divided by the earnings before taxes. So you are actually paying 36%, right? That's what happened here. 36% as a total of the earnings, and that's an alternative to use. And coming up here, that value, right, from a historical perspective to come out how much is going to be the EBIT 1 minus T calculation, right? And arriving to a different free cash flow than the one that we before. Since the tax rate is higher, right, it should be lower. Right? That's an alternative way to do it, right? It may seem correct, right? But it has some caveats, right? Because in reality, this is what's happening. And I'm going to put here 1. I just want to show you. What's this going to be occurring? I'm also saving this into the blackboard in a bit, right? In reality, what you should be thinking about is, okay, what are the taxes that I'm paying, right? This is going to become earnings minus taxes. Earnings before interest and taxes minus taxes, right? What are the taxes that I'm paying? The actual taxes, the real taxes we are paying at this time. Right? And those are going to be, copy the format, 141,603. Yes, I know that this is a little bit odd. Right? At 319,133. And we are using the actual taxes. The actual income taxes that you have. That's the way you're probably using, preparing in your valuation and investigación financiera, right? And this is a mistake most people are making. In this tax number, there's an interest action included there, right? You should be realizing this. In this tax value that I have here, 141,603, there's the interest action coming up from interest expenses, right? It's already embedded in there as part of our calculation, right? So we should be adjusting that, right? We should be adjusting that when coming up with our, sorry, I'm jumping to many things. We should be adjusting that. Here there should be an interest taxable adjustment. We shouldn't be considered, once again, we shouldn't be considered interest taxable when calculating free cash flow, right? If you consider interest taxables, you are calculating capital cash flow, remember. If you consider free cash flows into the numerator, you can no longer consider the interest taxables in the denominator, in the discount rate. You cannot use interest taxable numerator and wacc, right? So we should adjust here, right, for the interest taxable. And I wrongfully erase this here. Second. Okay. So we need the interest taxables right here. How do you get the interest taxables? You need the interest expense that we're going to be seeing, right? I'm also going to consider the financial income that you are receiving, right? And I'm also taking into account the change in effects or the difference in effects that is being affecting out around here, right? In your forecast, you are going to see that the difference in effects, right, does not affect at all. But in here, I'm going to be taking that as a consideration. Get the numbers correctly, right? 1,717.95. Unfortunately, this is in image, right, which is not allowing me to copy and paste them so easily, right? But what I just put over here, once again, what I just put over here is the interest expense, right, plus the FX difference in cambio, minus the interest income, right? That's your financial expenses, right? And I'm gonna multiply that times effective tax rate, right? In order to calculate the interest tax rate. Sorry, I clicked the wrong button. We are gonna be observing EBIT minus taxes, right? And I'm gonna be, let me 1 second, I'm subtracting the interest taxes, not to consider those interest taxes in the actual taxes, right? So it's like there weren't any interest expense and income, right? And you are paying more taxes due to them. That's why this EBIT 1 minus T number should be this calculation instead of this one, right? Slightly similar, but not quite, because of the effect of the interest taxes that I mentioned a while ago, right? Okay. So let's wrap it up over here. So next class, by the way, it's on one of our recovery class. So let me switch to Spanish to make it more clear, ¿sí? La siguiente clase es una clase de recuperación. Vamos a ir con Free Cash Flow y entramos ya a hablar de las tasas de descuento, Weighted Average Cost of Capital rápidamente y armamos una serie de modelos rápidos de visualizar. Entramos a ver algo de Terminal Value y los trucos que normalmente van a observar en esos elementos. La clase de recuperación nuevamente el jueves, 7:30, 9:30, 2 horas, lo igual que siempre. De ahí es el sábado a las 4 y el domingo a las 11. Lo he puesto en Blackboard. Es simplemente, entra a cualquiera de las 3 sesiones, ¿sí? Y se va a repetir básicamente el mismo ejercicio. Adicionalmente a eso, dado que ya me respondieron de la facultad, en unos minutos cargo las indicaciones para el trabajo final y con eso ya tenemos la fecha límite, que es lo que necesitaba yo saber, cuál es la fecha límite que entregar notas para saber cuál es la fecha límite que puedo darles, ¿no? Yo trato de darles la mayor, trato de ajustarme yo lo más posible en ese aspecto. Y usualmente salgo un día o 2 días de vacaciones para terminar de corregir. Ese ha sido lo usual en los años pasados. Bueno, terminamos por eso por el día de hoy y muchas